Hey there, and welcome to the final episode of my first time homebuyer guide. If this is your first video in the series, well, I'd recommend going back to the first episode because today we're connecting all the dots and tying up everything we didn't get to yet. Now, if you've made it through the first 10 episodes, first of all, you're amazing. And second, you know we've covered a lot. But as I looked back, I realized there were a few nuggets I either didn't have time to squeeze in or just totally forgot to say out loud. And they really deserve a spot in this series. So before we dive into your questions, let's add in those missing puzzle pieces. Let's go back to video 3 really quick, the one about how much home you can actually afford. There were a couple things I wanted to elaborate on, especially around specialized inspections, credit details, and condo townhouse financing. We covered the general home inspections earlier, but here's what I didn't get to explain. Some homes really do need specialized inspections, depending on features, age, and location. These aren't always required, but they can reveal major issues your standard home inspection might miss and cost you thousands. Here are a few to keep in mind. A sewer scope inspection. It sends a camera down the main drain line and checks for damage, root intrusion, blockages, and pipe collapses. It's recommended for homes built before the 1980s, if the home drains slowly, or if there are large trees near the line. The cost is normally around $250 to $500, and the possible risk, if skipped, is around $5,000 to $15,000 in repairs. Chimney and fireplace inspections. It checks the flue liner, the soot buildup, ventilation, chimney structure, the firebox condition. It's recommended for wood-burning fireplaces, older homes, or signs of water damage. That is around $200 to $400. Specialized pool inspections. It tests mechanical systems, the structure, safety features, teaches you pool care. And it's always recommended when you have a pool. That's around $150 to $400. Solar panel inspection. Reviews ownership, energy production, warranties, transfer options. That cost is around $200 to $400. Also requests 12-month of electrical bills and the solar agreement details. Propane tank and system inspection. It tests the tank, regulators, and lines. It verifies ownership, appliance usage. That cost is $150 to $300. These inspections may not apply to every home, but when they do, skipping them can be a costly mistake. Ask your agent if any of these should be a part of your inspection plan. In that same video, we talked about reviewing your credit report and knowing your credit score. But here's one thing I forgot to explain, and it's a big one. Even if you're only carrying a small balance, say $1,000, lenders still look at your total available credit. So if your card has $15,000 limit, they assume you could spend all of it at any time. That potential risk affects how much they're willing to lend you. This is what's called your credit utilization ratio, and it's one of the biggest factors in your credit score. The lower your utilization, the better. Ideally under 30%, but under 10% is even stronger if you're about to apply for a mortgage. This little detail can seriously impact your interest rate or whether you qualify. So if you're prepping to buy, it's worth paying down those balances early and keeping your usage low. And then we talked about loan types: FHA, conventional, VA, USDA. Here's what trips up a lot of first-time buyers. Not all properties qualify for every loan. Condos and some townhouses are part of HOAs, which lenders evaluate too. They look at owner occupancy versus rental ratios, HOA lawsuits or delinquent dues, adequate insurance coverage, project approval status for FHA or VA. So even if you are totally qualified, if your property isn't, your loan could be denied. That's why it's so important to work with a lender and an agent who can check the property's eligibility early before you fall in love and write that offer, especially when you're looking at condos and townhouses. Let's jump to video 5, where we talked about writing strong offers. Sometimes a seller needs to stay in the home after closing. Maybe they're waiting on their next place, coordinating a move, or just want a little breathing room. In that case, you might offer a leaseback, which lets them rent the home from you for a short time after the deal closes. Smart, right? But here's what first-time buyers don't know. Some loan types like FHA, VA, and even conventional require that you, the buyer, move in within 30 to 60 days after closing. That means leasebacks have a time limit. You can't let the seller stay indefinitely, or you're at risk of violating your loan terms. Always talk with your lender before offering this, and make sure the move-in timeline matches your loan requirements. And in a competitive market, first-time buyers can feel like underdogs, especially when bidding wars start. But if you fall in love with the home, great location, fully updated, everything you can imagine, you might consider a strategy called the appraisal gap coverage. Let's say the home appraises for less than your offer. Normally, that gap could kill the deal. But with the appraisal gap language, you say, if the home appraises below our offer, I agree to pay X over the appraised value, up to a cap. Example, if you offer $350,000 and the appraisal comes in at $340, and you agree to cover $10K gap, you'd bring an extra $10K in cash to closing. It's bold, it's strategic, and in the right situation, it can give you the edge. Just make sure you have the cash and the stomach for it. We'll run the numbers together before writing anything into the contract. Don't worry. And remember back in video 7, when we covered the mortgage and title process, we talked about how your loan gets finalized and how the title company clears the way for closing. But here's one piece I didn't explain, and it's important as well too. At some point of the process, during the title process, you'll be asked how you want to take title. It isn't just paperwork, it's how your ownership is legally recorded. And it affects what happens to the home if something unexpected occurs. Here are the most common options. Joint tenancy with the right of survivorship. Equal shares between ownership. If one passes away, their share automatically goes to the other owner. Often used by married couples or long-term partners. Tenancy in common. Ownership shares can be unequal. 70-30. If one person passes away, their share goes to the heir, not the other owner. Often used by siblings, friends, or business partners. Tenancies by the interee. I know I was going to mess one of them up. Similar to joint tenancy, but only available to married couples in certain states. May offer extra legal protection from individual debts. And then, sole ownership. One person holds title completely. Used by a single buyer, or where one spouse isn't listed. If you're not sure which one fits you best, your title agent or real estate attorney can help you walk you through what makes best sense for you based on your relationship, your goals, and your state laws. Look, There is a ton of behind the scenes work that goes into protecting your best interest as a buyer. That's why it's so important to have someone experienced on your side who can spot these things before they become problems. And hey, there are still more real estate terms out there that didn't make it into this series. But we had to stop somewhere, right? So check the comments below. I'm dropping a few bonus definitions there for anyone who wants to go deeper. Now that we've filled in those last few gaps, I'm pretty sure I'll come up with more. Let's get into your questions. Question 1. What does as is mean in the contract? As is means the seller is saying, I am not making any repairs. What you see is what you get. But that doesn't mean you can't inspect the home. You absolutely should. You should get a full inspection period and can walk away if something major comes up, like a bad roof or faulty wiring, as long as you're within your contract timeline. Think of it as this. As is doesn't mean you're stuck. It means the seller isn't obligated to fix anything, but you can still back out if you find something serious and no longer want the home. Question 2. Can I still ask for updates or repairs in an as-is sale? Technically, yes, you can always ask. It is a negotiation. But in an as-is sale, the seller isn't required to say yes. And in a competitive market, asking for too much can hurt your chances. Here's the sweet spot. Don't ask for cosmetic updates like countertops or paint. Do ask for major safety or system issues like electrical hazards or broken HVAC, especially if they weren't disclosed. If you phrase it as a credit at closing instead of a repair, the sellers are more often open. Why? Because they don't have to schedule contractors, and you still get help covering the cost. And you can absolutely ask if the update relates to something that affects safety or financing. The seller doesn't have to say yes, but it doesn't mean the conversation ends. In fact, in some cases, you need to have that conversation. Let's say the roof is past life expectancy or the panel is on the insurance no-go list. Even if the seller says as is, your lender may say, no way. No insurance, no loan, no deal. But that isn't just your problem. It's now the seller's too. And that's where a good agent earns their stripes. We'll step in and remind the listing agent that it isn't just being picky. It's about the deal falling apart for any buyer with financing. If it's not addressed now, you'll have to disclose to every buyer moving forward. So at that point, the seller has a choice. Make the fix now and close the deal, or go back into the market and limit your pool to cash-only buyers and investors. So yes, as is has boundaries, but if repairs make or break insurance, it's very much on the table. Okay, you've officially made it to the end of the First Time Home Buyer Guide. If you've watched the full series, you're not just ready, you're informed, you're confident, and you're way ahead of new buyers out there. And hey, you might not need me again for a few years, but when you're ready to upsize, relocate, or just move on to something new, I'll be launching a first-time home seller series guide soon, because selling a home, well, that's a whole different ballgame. So whether that's 5 years down the road or next month, I've got you covered. And if you know someone who's already there, a friend, coworker, family member, I'd be honored if you'd share this channel with them too. I'm not going to get emotional. Buying your first home is a milestone, and it should feel exciting. And I hope this series made you feel more prepared and a lot more supported. Because remember, you don't need to know everything. You just need someone to explain it clearly. It maybe makes you laugh a little along the way. And that's what I'm always here to do. Every question, every key, every closing signature. You've got this, and I've got you. Thanks so much for being here. And I'm so stupid.